Of course, the big one back on Tuesday, the RBA cutting the cash rate by 25 basis points. Roger, from a market perspective, they always like to see a fall in cash rate. Helps sometimes to move money into equities. I mean, were you surprised?
No, I'm never surprised by changes to interest rates because simply they'll keep changing. And and you know, we tend to spend a lot of energy focusing on the very short term.
Too much? Do you think there's too much analysis and focus on it?
Well, yes, I do, but it also, you know, look, the reality is that it's of interest to some viewers and it matters at that time. But for long-term investors, I mean, if you'd bought a real estate group at its float and you bought car sales or Cochlear and CSL, you've done really well, and there's been lots of budgets. There's been lots of rate changes, you know, and so I think the focus should be, for me at least, and for our investors, it should be on buying great businesses when they're cheap. The reality is, as interest rates go down, the effect of that declining interest rate is to raise valuations, and I don't mean prices. It also has the effect of raising prices, but it raises the intrinsic values. There's an inverse relationship between interest rates and bond prices. But what people don't understand is there's also an inverse relationship between interest rates and the valuations of all assets, property, businesses, shares. And so values go up as interest rates go down, and of course as interest rates get to the point where people can't survive on their term deposits, they move money into the stock market, and that is precisely what the RBA wants. The big issue is the Australian dollar and the effect that's having on Australia's competitiveness. We've seen the demise of manufacturing in Australia, retail is suffering, tourism is suffering, food production in Australia is suffering because of the high Australian dollar. And so the RBA needs to act on that as well.
But what more can they do? I mean, they can cut a cash rate, but it doesn't seem to deter people moving into the Aussie dollar because it's more of a, despite last night, more of a weak US dollar, isn't it?
Well, the Federal Reserve and the ECB has led the way. They've shown everyone what's possible. So, and
not
so
quite
has the Bank of Japan.
Not here in Australia, though, of some of those central banks.
Well, you know, we've got printing machines. If they wanted to do that, they could. But at the moment, we've still got flexibility on our rates, which those countries don't have. There's not much. You can't go much lower than zero, and so Australia still has some movement on interest rates. But it really depends. What we really need to see is stronger growth globally, and hopefully that'll have the effect of reducing the relative attractiveness of our interest rates in Australia.
It's often fated as a fantastic result when we see the cash rate cut and banks pass on, because it means people with mortgages obviously get a little bit more breathing room, but not everyone has a mortgage.
They're under enormous pressure to grow in a zero credit growth environment. So revenues haven't grown, and so you've got no revenue growth. So really, if the costs go up, so this is the first thing, if costs rise when you've got no revenue growth, then you could really see yourself in a negative profit growth situation, so profits actually declining. But more importantly, when you've got negative credit growth and low interest rates, as we do in Australia, low credit growth or no credit growth and low interest rates, and you've got a structural issue around your net interest margin. So how are you going to grow profits? Well, the only thing you can do is perhaps pass on some of the benefits of lower funding costs, as the ANZ has done at the margin. I mean, who's going to change their decision about whether or not they're going to borrow money or not by 0.02 of a basis point? No one's really going to care. But they're hoping that they can just edge a little bit of get a bit of market share where otherwise there is no growth. And we know this because, quite frankly, if you can grow credit, you'll retain profits, and you'll generate a high rate of return on your retained profits, and that increases your intrinsic value of your business. But the fact that they can't do it is reflected in the fact that they're increasing their payout ratios on their dividends. They're saying, well, we can't actually employ this capital. No one wants the money.
So could we be seeing a price war then?
Well, it's precisely what. Well, I don't know whether we'll see a price war, but I do believe that what the ANZ is trying to do is just extract some growth out of this zero growth environment in credit.
The big miners who've had a good week this week, largely off the back of some decent, particularly technical moves in the copper price and a little bit more optimism over the outlook for the global growth. I mean, is it an area that you like? Because people have been pretty down on this sector for a while.
We sold all of our mining. We had no mining exposure during the boom. And we did have mining services. We exposed ourselves through mining services businesses. So we owned the forges, the deck mills. We bought a company called Matrix Composites and Engineering, and companies like that went from $3 to $9. But we sold out of everything last year and before that. And in fact, we sold the last of our mining services companies in April last year, so a year ago, and we haven't participated in them since, because we believe, and it's only our belief, it's one man's belief really, that Basic Economics 101 tells you, we've had Rio this week say we're pushing on with the Pilbara, BHP said we're pushing on with the Pilbara, you've had Roy Hill pushing on.
Twiggy and Fortescue as well pushing on.
Yeah, everyone's pushing on with this iron ore supply, and that just tells me that the iron ore price has to fall, because it's coming at precisely the same time that China is trying to change its growth profile from infrastructure to consumption-led growth. That doesn't mean they're going to decrease the amount of iron ore they need, but the rate of increase is going to decline. And we're going to have a massive supply response. We're going to have 2 Pilbaras of additional iron ore being produced every year, 700 million tonnes. The price can only go lower.
But
I could be wrong on that.
Well, they counter then it becomes more of a volume game, that you start to increase volumes as price. I mean, it's never a perfect offset, but you had the Rio, I think, president of Iron Ore Asia or whatever, coming out and suggesting 3% annual growth in steel demand coming out of China, and that will be enough to maintain, if you like.
Not if you double, triple or quadruple the supply of iron ore. That's the issue. Everyone has to remember that between, and I'm just picking, so it doesn't matter how far back you go, but from 2004 backwards, let's go back 20 years, the price of iron ore traded between $10 and $20 US a metric tonne. Yeah. And then between 2004 and 2007, in the space of 7 years, it went from $20 a tonne to 187 US dollars a tonne. And everyone thinks this is the new normal. Humans are very bad at predicting turning points. We're good at predicting the status quo continuing, but terrible at predicting turning points. And I just think we could be on the cusp of another turning point.
Productivity, Neil, continues to be an issue that we hear from a lot of companies, not just the likes of the miners, but we've heard it from Richard Goyder, from Wesfarmers and all sorts of the corporate landscape. Is it something that is on the onus of the government in terms of their fiscal policy, or is it the private sector, or do you think it's both?
I believe that we're now facing the result of decades of mismanagement by successive governments in Australia, and we see that when I had breakfast late last year with Andrew Robb, the opposition minister for debt reduction and a whole bunch of other things. And Andrew said this word to me. We're talking about the balance of payments, and he said it's structural, which basically means we can't do anything about it. And what he's talking about is this idea that the value of our imports is always going to be higher than the value of our exports. But that just doesn't make any sense. The reason why the value of our exports is so low is because we don't add any value to our exports. We export the raw tomatoes and then we import canned tomatoes from Italy. We export the dirt and we import the steel. We've been doing this for 20 years. 20 years ago we were exporting the wood chips and we're importing the paper. So, the government doesn't do anything about letting markets decide. Maybe they're not the best group to decide, the government, but deciding which industries can add value. We should be exporting education. They should be incentivising that. We should be adding value to our raw materials and exporting it. We allow these cheap, low-grade exports to go out where we're a price taker. And as a result, we don't know who we're going to sell to, we don't know what price we're going to get, but we're forced to import the finished product. So I think it's 2 tonnes of iron ore or something that we need to, sorry, it's more than that, it's 3 or 4 tonnes of iron ore that we've got to export in order to bring in one iPhone. And it's a big disparity, and we can fix it. We can fix it by adding value to our exports, or at least incentivising, broad brush, incentivising people to set up. In Singapore, you go to Singapore, you start a new business, and for 3 years, $200,000 tax-free profit, your first $200,000, you don't pay any tax on that profit, and you pay a very low rate on the next $100,000 for the first 3 years when you start a business. We don't have anything like that in Australia. We screw everyone for the first dollar that they earn.
Yeah, I'm always surprised there's not a sort of a Silicon Valley type.
Yeah, well, there should be. We've got smart people in this country.
And it's a nice place to live. I mean,
it's a great place to live.
You could attract lots of talented people to come here.
Exactly. And so because we're not doing that, we need that, I mentioned it earlier, we need that inflow into the capital account. So we have to sell our businesses, we have to sell our farms, we have to sell to get capital in to fund the fact that we're being profligate on the current account side.
I mean, do you have any confidence that we are likely to see that? There doesn't seem to be a lot of long-term
Andrew Robb's
thinking.
in the opposition. He called it a structural deficit. They're going to come in if they do, and there will be no change. So I despair for Australia, I really do.
Does it impact your investment strategy, or it doesn't really have any bearing at all when you're looking at
because
your
we're looking
intrinsic?
we're looking for businesses that are going to succeed irrespective of who's in government. We're looking for businesses that are going to succeed irrespective of what's going on in Cyprus. And, we've bought businesses whose earnings have grown 20, 30, 40% per annum. And they did that in the last reporting season. They did it the reporting season before. And if they don't do it again next reporting season, it'll be 10 or 15%, but it'll still be attractive.
But is that pool of growth stocks growing, or is it diminishing?
No, well, it's been diminishing because there haven't been new IPOs, because the stock market hasn't been buoyant. But I think that we'll see a demographic shift. We'll see the baby boomers retiring. There's a whole bunch of really good businesses that they want to sell and they want to retire. And when that happens, we'll see a whole lot of great businesses floated. We'll see a new generation of management come through and manage those businesses. And we might see some wonderful new exports.